Good evening, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective and the Adapted Perspective social media platforms. And I am back to talk about our stock market strategy, our stock market investment strategy, utilizing closed-end funds. But I'm going to do it a little bit differently this video. So, to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a financial strategist, and I don't speak like the herd. I walk in a limited company, and sometimes I walk alone. So, getting into it, this was a challenging week for me. Did oh good. Microsoft has been extra glitchy because since they force installed their most recent update and fixed issues, which I mean it was buggy to start, but it's been buggier since then. So it was a rough week. Getting back in schedule, getting back into tracking the budget and everything else. Just seems to be a very financially laden season for us. So, following last week's video, I was my intention, honestly, to invest on Monday, but then it just got distracted by other things. And then I caught an interesting story out of, or maybe Western Europe, that Great Britain and France maybe were looking to flood the U.S. bond market and attempt to crash the U.S. bond market because the United States was trying to get Ukraine to sign a deal that not all of NATO had approved, and all this political intrigue. Uh, so instead of fear selling, what the herd would do, I just waited because I figured if it was an option, if it was a realistic threat, they would actually follow through. But it's just hype. Um, but at any rate, we ended up sitting and not buying. But it's just been a hard week, harder than normal. Just a lot going on. So on my end of things, the closed-end fund list did not get updated this weekend. Saturday was constant. I mean, it was busy. Today was busy. Um, so much going on that you can't do the normal stuff, and it's not bad stuff. It's not uh, it's not overtly stressful stuff. It's just it took like today in the normal prep work for the week. Um, we've had a car in the shop. We picked that up today. Independent mechanic, yes, is open today. Not any other business mechanic would not be open today. But pick our car up today, go through that, go through all that, and then get home and maybe from 1 o'clock to about 6 o'clock or so, it's just prepping food for the week, prepping different stuff for the week. Um, it's the last week of school before Christmas break, so there's just a lot going on. But what that means is other stuff just doesn't get done. Frustratingly so. So, as I prep this video, even before the weekend, outside of a couple political headlines, not much has really changed. And it feels like I could really have made the same exact video for the last 6 to 8 weeks. And I like reporting, I like synthesizing, I like teaching, I like all that stuff. And while some of the headlines will change, the core strategy has been the same. It's bonds and bonds proxies, uh, U.S. investment, U.S. bonds, all American companies, uh, U.S. based blue chips, like U.S. investment heavy, uh, not really looking outside of the U.S. into international anything. Maybe outside of North American real estate, but beyond that, not really looking into international anything. And it's not getting monotonous, but it does feel like I'm saying the same thing over and over. So I wanted to do it differently. So instead of targeting closed-end funds based on the same stuff, and you know, I've already been forthcoming that I don't have the list because it just didn't happen. But knowing how it's gone and knowing that not much has changed, yes, the Fed cut rates another 0.25%, yay. Um, Knowing that not much has changed doesn't, or I guess it leads me to believe that not much has changed. Like I could run all the data and still find the same stuff. So I thought about how I would make this video, what I would say differently. And instead of going through the normal numbers and the sorting, I wanted to treat it more like a strategy video. And I started thinking about the differences of our funds. Like we have a Roth, and then we have um, it's like a money market cash brokerage account. So are they different? Yes and no. They're set up very similarly. Um, the goal overall, regardless of take, my goal overall is to create a no withdrawal portfolio. Not in the sense of I'm never buying, like I'm buying, yes, but I'm never selling. It's that I don't want to take money out. I want to push that money forward so I can continue to grow our dividends and then increase our later income, right? Either A, have more income to pay off daily stuff if we need it, but really to have more income in retirement. And yes, it's a cash based money market account or cash based brokerage it's going to get taxed differently than the Roth. But the goal is a no withdrawal portfolio so that even when we buy and sell, it still stays inside. Our overall value grows, our overall dividend grows. The Roth is a similar thing, but I want to set my Roth, and I think I've done it decently, but I want to set it up to where it doesn't really, oh, how to say this? Like there's very little selling. It's more of a buy and hold setup. Now, I've not been extremely faithful to that. There's currently, and I can show it. So ideally, the Roth would be more uh, bonds and bonds proxies, right? So outright bonds. It doesn't need to be municipal because it's already a tax-free account. So uh, utilities, oil and gas to a degree, real estate to it, right? So bonds and bonds proxies, BDCs, and then maybe cyclical investment into either uh, like right now everything's pouring into the U.S., so it would be more U.S. focused. But then also add international bonds at some point, and then that way, regardless of season, regardless of weather, that portfolio just pays. And when it generates dividends, we reinvest the dividends. We're not really selling funds. Now, in doing that, let me get over to that portfolio and then I'll share my screen. In differentiating portfolios, man, this thing is sketchy. Uh, it's not set up exactly, all right, maybe that idealistic way. Like CIF, we bought on the roller coaster and it's earmarked, sell at $3. So based on its history, when interest rates are high, the share value has been lower. I'm hoping it follows trend so that when interest rates go lower, share price goes higher. That's been the roller coaster ride. But of what would be the mainstays, BRW would stay, FSCO would stay, HFR is real estate, HGLB I'm still mixed on. Like I love the gains, but and we're holding it. Like it pays phenomenal, right? But at the same time, is there something better? Or should we look at something better? And I'm still 50-50. I can argue for and against. NBXG is straight stocks and it's 5G tech. And that's where I think it would either be selective US stock or either cyclical based on the overall strategy for the market. OXLC is that CLO market, which is kind of like it's kind of a bond proxy. It's very much its own thing. Um, and then RFI is real estate. So I would love to keep this a bond and bonds proxy focused investment and build so like international add AFW, add PDO or PDI, add DSL at some point. Uh, Maybe this is kind of outdated. Um, so if I'm looking at bonds, so AWF, PDO, DSL. If I'm looking more at bonds proxies, that's DNP and MEGI. MEGI's a term fund, but it would be okay in the short run or until the sell date. Um, and then continued investment in what we already have. Could I argue for cyclical investment in specific, say, US focused or at least US forward portfolios? USA, ASG, ADX. Uh, USA and ASG seem much more of a cyclical thing. Like if you look at their price histories, they really do go up and down versus ADX just goes up. Like ADX, yeah, like you get the little, right, a little bit, but it really just goes up. So in the cyclical nature of things, maybe USA or ASG, pending whether it's a US focused or international focused overall strategy or overall, mm, say current maybe or current wave. Um, and then ADX for the long term, but really a bonds and bonds proxy focused portfolio versus the cash brokerage is a mixture of everything. And it's optimizing the current, like it's anything in the current market, but it's optimizing the current market, really prioritizing and scooping existing deals for the long term, but at the same time, not boxing myself in and never selling versus the Roth is I want an income generating machine that's tax free. So to play the game of the Roth, yes, ideally max it out every year, right? It's you can put up to currently, I think it's 7,000 a year. So, and even though, and I will be, I mean, yes, you can see what I can see. You've got up until April really to add money for 2025. So if I dumped 7 grand almost into the Roth between now and April, what would I invest in? Same stuff. Bonds and bonds proxies, same stuff we've been targeting. FSCO, BRW, uh, utility. I think I would go more DNP or MEGI as opposed to individual oil and gas, uh, like KYN or NML. Um, let's see. I would go eight ADX if it had the right metric, but I mean we could play the odds, I guess you could say, and buy USA and ASJ cheap. The caveat to those is they don't pay the next dividend we would qualify for would be March. It's really hard to buy something now and wait 3 months to get a dividend. Uh, NBXG I think is great as a long-term mainstay. Uh, yeah, everything else is marked lifetime or just long-term. Versus this one, almost anything is always fair game. But it's there are some things that are marked long-term or lifetime. Just I mean, um, there are other things that are marked short-term or swing, and it really just depends on the overall market. Like at some point we are, even though I don't think we're gonna be like, let me get my head on straight, or at least try to get my words out right. So in 2018, 2019, we hit a point where we were overproducing oil and we had way too much oil to the point where the oil market dropped out. We had such a surplus that it was just wasn't worthless, but uh, it was uber cheap for oil. And then it came back. And with technology and this rise in technology, we're always going to need oil. Now, the day-to-day cost of gas, I think, is going to continue to drop, but it's not like we're going to hit a mark where it's 5 cents for gas. Although that would be amazing, I don't think we're going to hit that spot. But in pockets of our West Houston area, like we have gas at below $2 a gallon, which is for the first time in a long time. So I think it'll go down further as we produce more. But at the same time, I don't know how far it's going to go. That being said, the more oil we produce, the more technology we produce, the more we're able to produce and build. So it's not like we're going to hit this cresting moment where we have just too much oil and nothing to do with it. But at some point, we're going to catch up where we have a ton of oil and the supply or the supply is going to keep increasing and the demand at some point will fall out. And whenever that happens, that's when it's time to sell KYN. So it's a swing. It's whenever it happens. At some point, we'll sell it. Versus, let's see, NML, XLC, ZTR has a specific sell point for me. And this is what I'm sticking with for now. So it's a hybrid utility fund. It's like, I want to say it's 75-25 bonds to stock. So with falling rates, the pricing should get better. If it climbs, right, hopefully it climbs back up between 10 and 12. And when that happens, that's when I sell it. USA's similarly marked. It doesn't have a price point, but at least I don't think it has a price point. I don't think I've set a price point. But it's marked as a short-term hold. It's all cyclical based on the general market. So if I was investing now, like if I had pick a number, if I had 5 grand to invest or 10 grand to invest into the brokerage, where would I put that? Based on the current market, similar to the Roth, bonds and bonds proxies, but this fund is set up a little bit, or say at least the overall goal of this fund is set up a little bit different than the other. I'm okay with buying and holding short term and then flipping into something else. But I'm not fixing up properties like what people do in real estate, but it's kind of the same mentality. In general, people I think get way too attached to funds, and y'all know me. I love certain funds, but at the same time, if it's not the market for it, you have to decide: do I wait and do I ride the financial roller coaster? So do if things are amazing, and then all of a sudden they like oil. At some point, we're going to hit that surplus oil. And as much as I love KYN and NML and what's in them, we run the risk of the value dropping out. So do we ride the financial roller coaster of decreased share price, hoping they can maintain the same dividend, even though we know that's probably not likely, just to buy it at the bottom and then scale it back up? Or do you sell it close to the top? It's hard to time the top. It's hard to time the exact bottom. But if you could sell it on the upward crest, right, take your profit. You could wait for it to bottom out, buy it again, same thing. But I'm more, I don't know. I'm like I'm actively managing both funds. It's almost just I associate that internal volatility more with this fund than the Roth. The Roth, I want to be like, I want it to, and I'm going to actively manage it, but I want it to be there and produce and not really have to worry about it. It's almost that set it and forget it thing. If I really wanted to, which I don't, but if I really wanted to, I could set all of those funds up through Fidelity, I think, all of those funds up uh, on a DRIP program, automatic dividend reinvesting, where instead of paying cash dividends, they would just pay partial shares. And that's never been my thing. I always want the cash dividend because just because pick a fund, ADX is going to give me partial shares instead of cash dividends, it might not be the best deal at the time. So the overall, dividend, in my experience, dividend reinvestment in general, your overall share price drops because they're giving you partial shares as opposed to a cash dividend. So in theory, your overall value is going up. But on my end, I want the cash dividend because I want to buy the best deal in the time. And as of last week, ADX was not the best buy. So the Roth, I want to be able to just let it be and not have a ton. Like I'm gonna look at it every week. Same thing as a cash brokerage. I'm gonna look at it every week, but I don't. Yeah, and selling CIF whenever that happens, I don't want to deal with this nature versus the cash brokerage has ASG, doesn't have CIF because I didn't want that roller coaster, but it has ASG, it has USA, it has ZTR, and it's going to see not a ton of volatility, not like your throttle right on the car, not like that, not changing gears, um, but just based on short term versus long term, it's going to see more volatility than say what I want my Roth to be. So it's the same strategy with decreasing rates, the bond market should pick up in value. So since I don't have the data, I haven't looked at stock numbers or values at all this weekend. I don't know what a quarter percent did to the overall market between Wednesday and Friday. But based on the emails I've read since then, not much. So with continuing rate cuts, the bond market value price point should take off. And on the closed-end fund world, I think the dividends will stay the same or get better. Um, with more investment into the United States, U.S. based blue chips, U.S. based stocks should do better, and almost everything will do better with a rate cut. So, if I had to prioritize what I would invest in the brokerage, I would still pick bonds, proxies, BDCs. Municipal funds have been higher than which impacts the dividend or not the dividend, the discount. Price point's been higher, but if the price point dropped out a little bit, I would go back to looking at municipal bonds. Uh, and in the meantime, it's paying attention to the discount and demanding the discount. It's a very target rich environment right now. But if we're going to prioritize funds, it's trimming the list based on discount. It's looking at when they pay, and I mean outside of NBXG, most stock-based funds pay quarterly, from my experience. And then uh, if we're prioritizing monthly payments, it's going to eliminate ADX, ASG, and USA. Uh, and yeah, on my end, it's hard to buy it. So if we bought USA and ASG now, we get a fantastic discount. We get a significant discount. They still pay a great dividend, but it's the wait time between now and March. Um, that's just not appealing. But that's the nature of that game. Um, so what would we buy with fine 5,000 investment? What would we target? It's really the same stuff. Bonds and bonds proxies. I would target FSCO, BRW. I would target energy if it fit the moniker. So that's DNP and MEGI. I would look at real estate. Real estate is projected to do exceedingly well in 2026. So That's RFI of what we already own, but in this one, it's also IGR. IGR is international real estate. For the Roth, that would be a great pickup. IGR pays an insanely good dividend, but also an insanely consistent dividend, and they raised it during the pandemic. So IGR would be a great pickup if it hit the metric on discount. In this fund, in the brokerage fund, it would be a great pickup because it's still significantly low on the price end of things. Uh, it's been more volatile than I thought it would be, but they've kept the dividend. So it would be a great dollar cost add, right? Or a great dollar cost addition overall. So this is last week's pricing, right? So our overall price 544. Last week pricing about $1 less. Like that'd be a great addition, especially if we bought more of it. Like if we just bought 50 shares, then we're not going to see a decrease in overall share price. And even honestly, even if we bought 150 shares, it's probably not going to decrease a lot. Um, let's see. I think that covers everything. So I would, regardless of account, I would still focus bonds, bonds proxies. I would focus U.S. investment, uh, U.S. investment, and then also energy, which impacts the overall technology front. On the Roth end of things, of what I would look to do long term is yes, CIF at some point, hopefully we sell. If it's the risk of the market. We bought it knowing it would be a financial roller coaster. So with lower rates, hopefully the bond prices pick up. And yet, yes, we sell it at or around $3. Um, OXLC, the CLO market space is still a cluster. But if we can get lower rates, maybe that market will level out. And then of what I would add international bonds. So I would add DSL, which is a mix, but I would add DSL. I would add the sister fund, DLY. I would add AFW, maybe PDI or PDO to this fund. And then, unless an amazing deal came along, which don't get me wrong, I'm always targeting discounts, I'm always targeting deals. But unless I don't even know how to say it, it's if I found another worthy fund, then I would add it, but it would have to be better than what we already have. But then this fund really just becomes bonds and bonds proxies. So outside of those three, uh, DNP utility fund, the Mega utility fund, even though it's a term fund. Um, think of what else I would put in overall IGR based on real estate. HFRO is very much US based. RFI is North America based. IGR would be a great international addition. And then focus on what is already in this portfolio. And then to add to it, it would have to be better than what we already have. And then this one, it will see more volatility in comparison to the Roth just because I'm willing to pick up almost anything. So long as I can scoop a deal now that would be better later. Uh, and I'm willing to look beyond the bonds and bonds proxy side of things. Uh, but it really just depends on how things are going in the market. So I know this is not my normal video. And I'm sorry for not having the data, but I just, it's been a weekend. So based on how things have gone, based on how I see things going into the final weeks of the year, um, the bigger headlines, I guess you could say, that the Santa rally seems to be on. Um, there, there is a positive push around Christmas time. Uh, the Trump administration looking to at least put the name out for a new Federal Reserve chair before Jay Powell's term ending is interesting. That could help or hurt. But I would love to say it could be helpful because it at least lets everybody know of the coming monetary policy. So if the way the media would spin it is they're going to put somebody in that'll cut rates regardless, but whoever that person is still going to have to deal with the overall committee of people, the Federal Reserve itself, but they're also going to have to actually follow the data and not their own personal aspirations or personal opinions. That's really been Powell's holdup. Powell's holdup has been one, his own power hungry self, and two, doing things that conflict with the data. Um, and yes, I will agree that the data is generally not what they're presenting us. It's always wishy-washy in general, but Powell has been a little more anti-data than others. So if it's well, I won't. Well, I'm not going to speculate on that. So if it's somebody who's going to follow the data and base decisions on the data, whether that's rate cuts or not, it at least gives the perception of better monetary policy coming into Jerome Powell's end. Uh, and then what else? So the Santa rally, the Fed chair, and I think overall it really is. It's a combination of things. It's the hope of additional rate cuts. It's also the ongoing production and increase of energy. And then it's the ongoing expansion of technology. And if you can get all things happening at the same time, then on our end of things, on the consumer end of things, we should end up with cheaper pricing, which also lets you invest more. But it also gives the market just a very different sense. So instead of the fear mongering that we've seen, the media is still going to spend stuff. I can't change that. But the overall investor sentiment should climb. So it should raise the value of the market. And it'll at least give us a short term view of how things are going to go the next 3-ish years. And what happens beyond that really depends on how well things go in the next 3 years. So that's really all I have. Um, if I if I look at it on my end to just rehash, the Roth is a bonds and bonds proxy setup. That's really kind of what I'm aiming for. Bonds and bonds proxies with limited US stock or maybe cyclical US stock investment versus the cash brokerage is much more uh, anything goes. It's scooping deals. They're both set up with the same idea: scoop deals in the current market that'll help us later. And if for some reason the bond market just looks like it's going to be completely washed out, I mean, I'm all for buying stuff when it's cheap, but if that's going to be a long-term thing, then those dividends are going to get cut. And as much as I don't want a lot of volatility in the Roth, if the bond market really is just going to go sideways and down, then fine, we will sell everything and completely restructure if needed. But that's not the goal. The goal is to position it to where, regardless of storm, regardless of weather, it just goes and I can add to it. That's great versus and it's not volatile, not like constantly up and down, but we'll say more funds considered, maybe more funds in the mix on the cash brokerage side of things. And if I was adding to both, I would still go bonds and bonds proxies, um, and then a toss up between technology and energy really depends on the best play. If I'm focused in the US, looking at rate cuts and the bond market, best fund to be in is still, I think, FSCO, with a close follow by BRW because I generally buy those in tandem. Uh, I could advocate for the stocks in general, so like ASG, USA, ADX, NBXG, but it's really hard to wait for dividend checks. I think on my front, the municipal bond space has been great, but those price points are a little high for me. Um, Trying to think what else. If I'm looking for end-to-end energy as well as just a super focused US based stock option, that's ADX. That's really the biggest difference between that portfolio and then I mean ASG is huge into huge into USA or ASG is huge into the US and blue chip companies that'll do well with technology. USA is the same thing. But what ADX has is that part of their portfolio where where it's invested into end to end oil supply and natural gas supply, which really does contribute into the overall infrastructure of building out pipelines and everything else. So that's all I got. We'll see what next week brings. If this week works out well, then I will finally be able to deep dive the entire closed end fund list and update everything and be able to give you data and not I mean, I think it's better than opinion, but at the same time, it still amounts to opinion. So my goal next week is data based on current intel with a mix of opinion, as opposed to this week is still my opinion of things going based on the last 6 to 8 weeks, which I guess is more than opinion, but yeah, it still works out to an overall strategy call. So uh, I'm looking forward to a highly successful week, and I hope you are too. There are but 2 weeks between now and Christmas. So if you haven't started your Christmas shopping or you haven't wrapped it up yet, you best be on it. Even Amazon's taking a while to deliver stuff. So I guess my last encouragement would be this, gentlemen. We have a horrible stereotype as seen in the Santa Claus movie with Tim Allen, but it's not the only movie that's portrayed us this way. That men simply forget about everybody important and we push our Christmas shopping off to the very last second and we end up not getting anybody anything because every store is closed. And I have no idea who you are. I have no idea what you're about. Have no idea if you do Christmas or not. But my advice to you is this: you if you buy Christmas gifts and if you do Christmas, don't wait till the last minute. Send yourself an email now and have that email say buy Christmas gifts now, right? Like I send myself emails, Monday to-do list, Tuesday this, that Wednesday. And when I get stuff done, I can cross it off. So send yourself an email, uh, like lunch break, Monday morning, whatever it is, buy Christmas gifts and go buy your family Christmas gifts. And if you can't afford anything, which I've been there, then make them something. Do something more than the bare absolute minimum. And help raise the overall image of men because we are so much better than society and culture portrays us. We do we do so much for our families. So I know you've got a lot going on. I know it's a stressful time of the year. Uh, I seem to be dealing with more financial issues, more financial stress than normal, and yes, I can talk with people about that, and I have. And I don't want to diminish the work that we do, but at the same time, it comes with the job. So part of being a man and leading a family is shouldering all the financial stuff and figuring out how to solve problems and solve problems well, not shirking the responsibility. So in being a man and in being a man's man and managing your finances and in managing your investments in the market, part of that is doing the other stuff too. Do not leave your family last. Do the hard stuff. And I get that it's hard to juggle different stuff, right? It's hard to juggle multiple things at times. So send yourself an email, do the stuff, and quite honestly, uh, don't be counted in that stereotype. Rise above and be a great example for another guy of how to lead and how to put your family in front of you and how to serve your family. And yeah, and that whatever version, however you want to categorize it, the man that Tim Allen was at the start of the Santa Claus is not the man that he was at the end. And yes, different transformation, but you catch my drift. Don't be that guy. Prioritize your family, which I know you do because you're investing and you care enough to invest. You care enough to take on the responsibility. So don't be the guy that waits to get everything done. Do the hard stuff, serve your family, get ready for Christmas. Uh, how much you buy into the commercialism is up to you. Me, I don't. And then stock market wise, sit down and think about your strategy, what you're really hoping to do. If you have different accounts, see if the strategy is different in each account. Uh, but really think about your strategy, and if you need to change it, then change it. But at the end of the day, and at the beginning of the day too, it's your money. You just need to figure out how you're going to use it and how you're going to invest it and what you're doing it towards. Like, why do it? So think about it. And if you have commentary, by all means, give me some. If you found the video helpful, by all means, like and share it. Follow the channel. Uh, if you want to comment on different funds, if you want to pick my brain about different funds, then by all means. Uh, for us, it's the hard part. So if I was actually going to buy something tomorrow, I would probably go with FSCO, but but it's really hard to do not having the data. On that decision, I would want the data. I don't want to buy blind. But I will confess that I am not buying tomorrow because I still have a lot of stuff I have to get done. To be honest, I have to pay off the November budget. Like the November budget is accounted for, and I get that it'll be almost halfway through December, but it's been nuts. So pay off December. I've got to deal with some Christmas gifts in the next couple of days. Uh, we started. We no longer escrow for our taxes, which has been an amazingly positive decision on our end of things. So I've got property tax stuff to pay for, uh, and then continue catching up on the December budget. Uh, hopefully not. Well, yeah, catch up on the December budget and see where we are there. Put it that way. Um, books wise, still working on it. The the closed end fund dividend book is, I think, about halfway through. I'm in a good place, making progress, and I don't know. It would be great to wrap that up by next year. We'll see. Third book is a scholarship book. Same thing. Have lots to do. Framework is there, but the goal is to get all three done, all three manuscripts done, put them in a more palatable format. Um, I can read typeface on white pages for, like page after page, but uh, a lot of people can't. So see if I can get those in a more palatable form, and then the goal is to release them, and then we go from there. Then at that point, I've got to make some strategy decisions on what I want to do on forefronts, Substack, Patreon, etc. I've got to find a marketing page for those ebooks, which I think I know where I want to go, but we'll see. Um, and if you want to chime in on advice, then I'm all ears. So if you want to comment stocks, comment books, comment marketing, anything in it and everything in between. If you want to give me feedback on the video, then drop me a comment and I'm all ears. So that's all I have. I think that covers everything. I think. Um, there we go. The mouse scared me for a second that the computer paused again, but mouse back on screen. Um, yeah. So I think that's the full update on my end with goals for the week. On your end of things, I wish you a great week. I wish you a productive week, and I wish you a successful week. And if you're part of the Christmas time spirit and part of the overall Christmas experience, then get your shopping done and uh, do not leave it waiting to the end. Get it done the sooner the better you can. And yep, that about covers it. So I wish you a great week, and I will see y'all later. Bye bye.